In this discussion, we will discuss the discussion question of list and discuss standards for comparison of financial ratios. When we see a discussion question or essay question like this, our goal typically is to add more information if possible. If we have time allowing, that being more likely for us to pick up the information that is being looked for within an essay question. And with a discussion question, we're usually given the information in order to add new stuff, new information, content to the discussion that is relevant to the discussion. Keeping that in mind, let's go through this one more time. List and discuss standards for comparison of financial ratios. One way to add more information oftentimes is to take a look at the question, take a step back and think, okay, what are we talking about here? Financial ratios. We want to have standards for them. We could think of why would we need standards? What are financial ratios? What are they used for? Who uses these financial statement ratios? These are all questions that are a bit broader than the specific question we have here. If time allows, or if we need more information for the discussion, that's one way that we can take a step back and look at this information. So the financial ratios are going to be a form of financial statement analysis. The financial statement analysis may be done by internal users or external users. In other words, they may be done by the people that are management within the company for decision-making purposes to get more information about the company for better decisions, or by external users, something like the investors or creditors or any other IRS or something, like anyone that's trying to analyze the financial statements for outside information to do basically business with the company. What are the financial statement ratios? The ratios are going to be a form of financial statement analysis. You could go into the other forms of analysis, which includes vertical analysis, horizontal analysis, ratio analysis. Ratio analysis being the one that we're basically picking key components of the financial statement, comparing them typically with a ratio division type problem, and looking at those ratios to see the comparisons of those numbers in relation to each other to get and glean and come away with insights about the company. And then once we have those standards, then we can think about, okay, what can we do with those ratios? And that's when we're discussing the standards for comparison. In other words, once we come up with these ratios, the question is, what standards are there that we can compare them to? Because if we have a number that's just in a vacuum, in a static vacuum, doesn't mean anything. The whole point is we're comparing things. That's what ratios do, comparing one number to another. And then we want to compare it somewhere else to see if it tells us about change, tells us about the way the company is working. So the standards are, we have intercompany standards, and we have the comparison with competitors, and we have industry comparisons, and we may have just kind of standard guideline type of comparison. So if we go through those, and this should just make natural sense, of course, if we have type of ratio analysis, what are we going to do with that? Well, one, we can compare it to the prior past performance of the business. We can say, okay, what happened in the past, in the ratios in the past compared to now, and we can look at that comparison and think about any change that has happened and whether that change is good or bad. So one comparison, one benchmark, one thing that we're going to compare against as we calculate the ratios for the current period are typically going to be prior periods, and we're going to look for trends within those prior periods. And then we're going to look for reasons why, decisions by the company or economic conditions that can account for those trends so that we can then make decisions going forward. Then we have comparisons with competitors. We're going to take a look at our major competitors. This will be different from company to company. Obviously, if we're in a type of industry where we have a lot of market power, and because we're in an oligopoly, or there's not a lot of people that do exactly what we do, then we're going to keep a close eye on the competitors. We're going to know exactly who they are, and then we'll basically want to take our benchmark numbers and compare it to the competitors' numbers to see how you're doing from the benchmark perspective. So these are going to be single competitors that we're typically taking a look at. And if we're if we're a company that has a lot of competition, we might pick the main competitors out there and try to think about them and compare and benchmark ourselves to them. If we're a small company and we're basically emulating in some ways larger companies, then the ratios allow us to do that kind of comparison, because we can't compare the dollar amounts, but we can compare the ratio amounts. And that's going to be one of the key factors, one of the key reasons that we use ratios rather than just dollar amounts. Here's the dollar change, here's the dollar difference. that doesn't tell us much when we're performance standards from one company to another, two companies of different sizes. Then we also have industry comparisons, which seems like the same thing, but they're not exactly the same thing, because the industry would mean that we're going to average the industry in some way. So if we're like in construction, we're going to average the industry in some way, and then we're going to compare our numbers to the average industry. So in other words, if we were comparing to like an oligopoly, that doesn't have a lot of competitors, we probably can compare to each of those individual competitors, because there's not that many of them, and we can compare to them. If we're in a company that has a lot of different competitors or a lot of variation, then we might have to compare to the standard. We might want to say, hey, just give me the average numbers, the average ratios for people that are in my standard. Now that's a lot more tricky to kind of think about, because we can group those averages. Anytime you get a bunch of averages, it should average out to something hopefully that has information for us and give us those average numbers. But it can also have strange kind of effects depending on how we calculate who is in the grouping and who is not. So when we think about the competition, we're thinking about like a particular companies. We're lining up our numbers to their numbers. Averages, we're thinking about all the companies put together, and we're kind of averaging their books together and looking in some format and looking at ratios in that format. So we can compare to industry standards. And those industry standards, where do we get that information? Different types of companies will compile these industry standards in different ways. And once we do that, we want to have some awareness of how these standards are being compiled. And then we might have some just guidelines, some rule of thumbs type guidelines. And these guidelines could just be kind of industry guidelines, like, what's going to be a good number for this type of ratio. They could be guidelines that we might think of if we're going to a bank or something like that, and we want to get a loan. Banks often have guidelines, kind of rule of thumbs type of rules, just general rules that say the ratio should be around this, this or better, because that's just going to be a general kind of rule that they're going to have. So we might have some of those just general rules within an industry or within a sector or within a financing sector that we can compare our ratios to as well.